Dear students, today we will look into some properties of return distributions that will be very helpful to later on understand portfolio theory. For stock returns, it is often assumed that they are normally distributed. To remind you of your statistics knowledge, a normal distribution is a specific form of distribution that is completely defined by its mean and standard deviation, often denoted by the Greek letters mu and sigma. If we now plot the daily returns of two DAX companies, BASF and Siemens, we see that the normal distribution using the mean and standard deviation of these empirically observed returns fits the observations quite well. We have some additional observations here in the region close to zero and also more than expected outliers with these extreme values here, but by and large the normal distribution fits the empirical observations well, and we can use it to characterize the distribution of stock returns. Now, what kind of distributions would investors prefer to see? Here we have two investments, investment B and C, which have more or less the same distribution, at least as far as standard deviation is concerned. However, we see that C is shifted to the right in terms of returns. It has a higher mean return than investment B. And of course, we assume that investors like return, whether these are already achieved returns in the past or whether investors think about the future and these are the distributions of their expected returns. In that case, investors of course would prefer investment C because it offers a higher expected return at the same risk. What about the situation here? So we still have investment B, which we saw before, but now we have an alternative investment A, which has the same mean return as investment B. However, as you can see, investment A is much more spread out, so extremer values have a higher probability with investment A. As we said, most investors are risk averse, so they dislike risk and will accept higher risk only if they receive a higher return as a compensation for this additional risk. But as the mean of these two distributions is the same, in this situation investment A does not offer any compensation for the additional risk. That is why most investors in this situation will prefer investment B, which has the same expected return but a lower standard deviation. As a normal distribution is completely defined by its mean and standard deviation, we only need these two items of information to evaluate two alternative investments. Therefore, we can look at these three cases presented here and make a decision in each of these cases which asset we would prefer. You can pause this video at this point to make up your mind about which asset you would prefer in each of the three cases. Are you ready? Well, let's have a look at case number 1. Here we have asset B with an expected return of 6% and an expected standard deviation of 20%. And we have asset A that has the same expected standard deviation but a higher expected return. And therefore asset A would be preferred in this case. Let's have a look at case number 2. Here we have again asset A with the same properties as before. And we now have a new asset C that has the same expected return as asset B above. However, it has a lower standard deviation. Here we have a case where we cannot make a clear decision without knowing what the risk-return trade-off is. So does asset A compensate us enough for the additional risk? So that we don't know at this point, so we cannot make a clear decision between asset A and asset C. What about the final case, 3? Here we compare asset A to a new asset D, which offers the same expected return but a lower standard deviation. Here the case is clear again, because asset D has lower risk but the same expected return, therefore investors would prefer asset D over asset A.